Silver got punished very badly 2 weeks ago. If you remember, Thursday and Friday, silver dropped from a high that week at 35 to a low on Monday's opening at 27.50. Wow, I'm talking futures now. Well, they close out this week at 32. Okay, so a lot of people assumed that silver has industrial aspects, and therefore, if we're going into recession, you sell all commodities, including silver, because it's got industrial aspects. The historical record of silver's trends does not correlate to the Bloomberg Commodity Index. It correlates to gold. And I think the people who shorted dumped silver a week ago.
Over the past week, the gold market experienced an extraordinary rally, with prices surging past the $3,200 per ounce mark to reach historic highs. This surge was driven by a combination of macroeconomic uncertainty, aggressive trade policy shifts, and heightened geopolitical tensions. Investors, increasingly wary of global instability, turned to gold as a preferred safe haven asset. Gold futures closed the week at approximately $3,244.60 per ounce, marking one of the most dramatic increases so far in 2025 and continuing a bullish streak that has already seen more than 20 record settlements this year. The dominant factor influencing this rally was the escalating trade dispute between the United States and China. Earlier in the week, President Trump announced sweeping tariff measures on Chinese goods, including a 145% blanket tariff that immediately unsettled global markets. China's retaliatory stance only served to magnify fears of a prolonged trade war with severe implications for global economic growth. Investors seeking shelter from this uncertainty flocked to gold, which has historically served as a hedge against inflation, currency devaluation, and geopolitical volatility. Though silver did not experience the same dramatic gains as gold, its stability amidst broader market volatility suggests that investors are still monitoring it closely. A resurgence in industrial demand or a shift in monetary policy dynamics could prompt a more aggressive rally in silver in the coming weeks. Veteran analyst and founder of Momentum Structural Analysis, Michael Oliver, presents an insightful analysis of the U.S. economy and the silver and gold market in a recent interview. According to Oliver, the coming moves in silver will be more impactful and stronger than anything we've seen in gold so far. As we present clips from Michael Oliver's interview, please take a little time to like this video, subscribe to the channel, and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
If you go back and look at other bear markets in the stock market and see what was a good place to be, 2000 to 2002, for example, gold went up, not explosively, it was just beginning its bull trend that went to 2011. But it bottomed in 2000, 2001 when the stock market started down. T-bonds went up, meaning yields dropped. So it was an alternative place. Same in 2007 to 2009. There was 1 month in there where gold got hit, but basically gold was going up in a major trend through 2011. T-bonds worked too. They were a good place to be. I thought this time they might be too, not because of that a fundamental assumption. The technicals looked right for a T-bond rally. Now, I know the U.S. T-bond market's, a pile of manure, okay? It's in a crisis mode, and I know that. And a lot of people I give credence to fundamentally and so forth say, this is garbage. Don't own that stuff. It's going to go through a crisis. I agree. But temporarily, it looked technically like T-bonds could rally, and they would do so when the stock market started to break hard. Well, sure enough, you go back a month or so ago when the stock market started to break, and T-bonds did move up. They moved from price levels like 115 up to 122 on the long-term 30-year bond futures. Nice, sharp move. And all of a sudden, in literally 48 hours a week ago, T-bonds spiked up to 122 plus, and they got to 111 within a couple days. Now, you say, well, 10% drop or so, no big deal. Well, for T-bonds, that's a crash. Okay. Something happened there, and it wasn't because stocks went up. Stocks were still going down, and bonds went with them. So that report you showed there, I was questioning at that point whether T-bonds are still any good or not. There's no issue in my mind. They're not an alternative place to be. That's our one fumble over the last year is thinking bonds could rally. Well, they did. They had a nice spike, but boy, did it fail. And we're left with one alternative in our assessment, and that's monetary metals. It means gold, silver, and the gold miners.
The big mama gold, as you call it.
Yeah, the mama market is gold.
Yeah.
And the little babies on a leash, or little puppies on a leash, would be silver and the gold and silver miners. And if you go through history, you'll see there are times when they vastly outperform gold on the upside, and then there's times when they vastly underperform. And gotten, well, now the miners have broken out. They've broken out versus gold recently in the last month or so, meaning their relative performance, technical behavior of miners versus gold. Like divide the price of GDX into the price of an ounce of gold and plot it, okay? That is broken out and telling us, in fact, before the recent surge in net price in the miners, it told us miners are now an outperformer to the mama, okay? Silver got punished very badly 2 weeks ago. If you remember, Thursday and Friday, silver dropped from a high that week at 35 to a low on Monday's opening at 27.50. Wow, I'm talking futures now. Whoa. Well, they close out this week at 32. Okay, so a lot of people assumed that silver has industrial aspects, and therefore, if we're going into recession, you sell all commodities, including silver, because it's got industrial aspects. The historical record of silver's trends does not correlate to the Bloomberg Commodity Index. It correlates to gold. And I think the people who shorted, dumped silver a week ago, made a big mistake. So I'll tell you what I did personally. I bought a lot of calls coming up out of that hole. I've been expecting an acceleration phase in silver and the gold and silver miners and gold to occur. And the thing that was needed was to break the stock market. Well, we've started that process in a way that people have been smacked in the face. They realize something's happening here. Okay. And they're moving into gold and related. And it's the next phase down in stocks, I think, will drive us off the page in gold and silver and the miners. We predicted before this drop occurred in the S&P that while it was very negative, going down for a long time, expect a bounce point. And we specified a number for the S&P, 4,800. Well, again, we're talking about a market that topped just above 6,000. Okay. It hit 4,830 this week and exploded the next day, which is what we expected to see, a bounce at that level. NASDAQ 100, we predicted, again, this is something that was like 22,000 or something to peak. It's 16,500. It bottomed this week at 16,500. I say bottomed, I mean bounced. And you can circle those lows on a price chart now. And the public, what they did is, if you go back to 2022 high in the S&P, it was 4,800. So people drew with a crayon, we make fun of them, and a ruler across that high, said, I'm going to buy it at 4,800. Okay. It worked. It should have worked because there were some other reasons for that to work as well. But it's temporary. And for the NASDAQ, if you went back to its peak, which was in November of 2021, its peak area was 16,700. We went down to 16,500 and boom, exploded. You go back through those lows going forward, whether it's a week from now, 2 days from now, a month from now, that's when the public is going to say, oh, hell, it's for real. A lot of them are still debating. They think, oh, if the tariff thing will end, it's all over. Well, Ray Dalio said, and he's right, this is much bigger than just the tariffs. That's an excuse. That's when you'll see acceleration in monetary metals.
The U.S. economy is navigating a complex landscape of policy shifts, market volatility, and mixed forecasts. President Donald Trump's sudden reversal of planned tariffs has introduced considerable uncertainty. Initially intended to stimulate domestic manufacturing and reduce trade deficits, the abrupt policy change has raised concerns among economists and businesses. Critics warn of potential inflation, supply chain disruptions, and diminished investment confidence due to unpredictable policy shifts. Former U.S. Treasury Secretary Lawrence H. Summers issued a sharp warning Tuesday about the risks posed by the U.S. government's trade policies, just as financial markets began. His remarks came before President Donald Trump announced a 125% tariff on Chinese imports, a move that briefly jolted global markets before a modest rebound. Summers, posting on social media, said recent developments suggest the U.S. could be headed toward a financial crisis driven entirely by its own tariff policy. He pointed to rising long-term interest rates and falling stock prices as early signs of deepening instability. He likened the situation to financial crises typically seen in emerging markets, warning that global investors are beginning to view the U.S. as a risky and unpredictable economy. "We are being treated by global financial markets like a problematic emerging market," Summers wrote. He cautioned that this perception, combined with America's high debt levels and reliance on foreign capital, could trigger dangerous economic spirals. However, others like Jim Rickards are pushing back against the anti-tariffs narrative. In a podcast interview, he argued that tariffs are actually beneficial for the U.S. and shift the economic burden away from consumers and onto foreign producers and importers, particularly in countries like China. Rickards explained that when tariffs raise costs, businesses can't simply pass those costs on to consumers without risking a drop in demand. If prices rise too high, customers walk away, and both the importer and the overseas manufacturer take the hit. This creates pressure on foreign producers to lower their prices or absorb some of the losses. As a result, he said, the idea that tariffs are inflationary or that they directly harm the American public doesn't hold up. Instead, he views tariffs as a strategic tool that strengthens the U.S. position in global trade. Let's get back to Michael Oliver's video as he shares further analysis about the U.S. economy.
Remember 2007, you peaked in October. The Fed started cutting rates for the first time in a while. They'd been raising rates after 2003, I think it was. But in 2005, they quit. But the market was topping in 2006 and 7, peaked in October. Well, they cut rates for the first time in September, 1 month before the high. And the market still went up, made a new high, S&P. Already the banks were headed down, by the way. We'll talk about that in a minute. And it wasn't until, now this is Bernanke now, he was hit. They cut rates all the way down, and a year after the high, in October of 2008, stock market had what you would call a crash month, 30% in October 2008. But in September, the month before that crash, Lehman Brothers went under. And the Fed had been doing nothing but cutting rates, thinking that would help, and it wasn't helping. Okay. Finally, Bernanke, after the blood was in the streets in November 2008, did QEs. Took the Japanese playbook and said, we're with you. And they did QE for a couple years, quantitative easing. This time around, in COVID sell-off, if you'll recall, the Fed actually went in and bought ETFs. They bought corporate debt ETFs, put them on their balance sheet. Now, what you're saying is that they've continued to let it drain. Well, are they going to be late again, as Bernanke was? And remember, Bernanke told the public, he says, mortgage situation is totally, quote, under control. So nobody should have gotten out of the stock market back in 2007 and 8, right? Okay. And he responded late. But the question is, does Powell remember that? Too late doesn't do any good. Because in November of 2008, after the October crash in October, stock market went down sharply again and kept going down till March, 31% more down after the October collapse. What happened in the November of 2008, after that October stock market sell-off, when stocks kept going down, gold exploded in November, and by early the next year was back at its highs. They QE took gold off the page and continued up to 2011. What's the Fed going to do now? Are they going to twiddle their fingers and say, well, the data looks good? You know, because it's old data. And there was even a woman reporter who asked Powell in that meeting on Friday, when he had a press conference, but don't you know those data points don't go negative until the stock market goes down? They're late in the game. So she kicked him in the shin. Maybe she should be head of the Fed. I don't know. So hopefully they're late again, because if they are, then they're going to have a bigger problem than even Bernanke had.
Yeah, and talking about the Fed, Michael, I saw there's I think she's the head of the let's see, Boston Fed
Okay, yeah.
came out this afternoon.
Mm-hmm.
Federal Reserve absolutely ready to help
Mm-hmm.
stabilize market if
Yep.
needed, top officials. The other thing I saw is here from Jamie Dimon. Dimon predicts Treasury market
Mm-hmm.
kerfuffle
Mm-hmm.
where Fed steps in. JP Morgan
Yep.
Chase.
Yep.
So
Yep.
it looks like people
Yeah.
are getting concerned.
Her phrase of various tools.
Yeah,
Okay, not cutting rates. They're going to start printing. They're going to start buying assets.
yeah,
And they've waited long enough, and even their friends, academic friends of the Fed and political friends of the concept of the Fed, yeah, what did she say? They're in various tools. There you go. She means not just rate cuts. Okay, so they're telling us ahead of time that they're ready to do some crazy stuff. So that balance sheet's going back up, and gold doesn't wait for the facts; it knows it ahead of time. And that means they're going to further degrade the speed of the degradation of the money unit by increasing the money supply. And they're going to come in and buy stuff. The problem is it don't work. Okay. Not in this kind of bubble. We have the biggest bubble in history. The liquidity that they create will go somewhere. But historically, it never goes into the breaking bubble. It goes into something like T bonds, and it always goes into gold and gold related.
As we continue to navigate through these volatile economic times, it's clear that gold and silver remain key players in the global financial market. The recent surge in gold prices, driven by escalating trade tensions and geopolitical uncertainty, highlights how precious metals act as safe haven assets during periods of instability. However, as Michael Oliver has emphasized, the market dynamics suggest that silver could be on the verge of an even more powerful move in the near future. On the broader economic front, the U.S. economy is facing a delicate balancing act, with unpredictable tariff policies and market volatility raising serious concerns. The mixed opinions from experts like Lawrence Summers and Jim Rickards underscore the complexity of the situation, with some warning of a potential financial crisis and others defending the strategic benefits of tariffs. As these events unfold, it's essential to remain informed and prepared for the shifting tides of both the precious metals market and the broader global economy. If you found this analysis valuable, we'd love to hear your thoughts. What do you think about the recent gold rally? Do you believe silver is poised to outperform in the near future? Drop your comments below and share your perspective. Also, don't forget to hit that like button if you enjoyed the video, subscribe to the channel, and turn on the notification bell so you never miss our deep dives into market trends, economic forecasts, and expert analyses like this one. Thank you for watching, and as always, we appreciate your support. Stay tuned for more updates, and we'll see you in the next video.